Hello, everyone. Happy for you to join us. Today is April 8th, midday. So we've seen a lot of market activity over the last week, and markets are responding positively so far today. But as we've seen, you never know how the rest of the day will end. I'm Philip Nelson, joined by my colleague Jennifer Appel. We wanted to just capture our thoughts and share with you all just some perspectives on the last week market activity we've seen. A lot of the turmoil associated with the recently announced tariff actions, and just give maybe some additional detail on what's the likelihood we'll see some of these tariff policies remain in force. What are some of the economic implications, and then obviously also what are just some thoughts on portfolios that we're seeing and been recommending to our clients. So with that, why don't we just get right into it? And just to set the table, Jen, for those that maybe have been on a long holiday with no internet, in the last week we've seen S&P have its biggest drop since March of 2020. We're now down nearly 20% since the February 19th peak for S&P 5. Just what are you seeing with equity markets today? And what have you been sharing with clients recently?
Yeah, thanks. And I'm really happy that you level set exactly when we're doing this, because I think my answer today is maybe a little bit different than it would have been yesterday, which is a testament to basically how much things have been moving around as the market is trying to grapple with all of the uncertainty around tariff policy and just a lot of the headline uncertainty that remains. So I don't want to anchor too much to what is happening at present in markets, but when we take a step back and just think about where we had been even coming into April 2nd, we were already at a pretty maybe more vulnerable market backdrop and market sentiment spot than we had been for some time leading up to the tariff announcements. And then, of course, the announcements became a catalyst for some pretty significant moves, as you mentioned, and some of the volatility we've seen across markets. And this all really comes back to it being a more aggressive announcement than I think what was priced in leading up to that. But basically, the response we've seen from markets has been this more dramatic write-down in growth expectations, along with some more heightened recession concerns that seem to be flowing through. So you're seeing that response across growth-sensitive assets like equities across the board. Even real assets have been selling off a bit as well. And then the rate side of things has been a little bit more mixed. I think we saw rates going down initially in that flight to safety that took hold, but they've crept up a little bit the last couple of days once again. So very much a fluid situation in terms of what we're seeing. And I should also add that we saw within credit that not too much movement on spreads. They're a little bit higher, but not on pace with really what we've seen on the equity side of things with the double-digit declines across markets. And maybe one thing that I can flip to you, Phil, in terms of some of the performance we saw, I didn't really talk about some of the safe haven assets like gold or the US dollar, but they've been acting maybe a little bit differently than we would expect. So you want to maybe comment on that?
Yeah, I mean, it's somewhat fascinating as we're somewhat trained in a Pavlovian way of when VIX is above 40, when markets are in turmoil and there's a lot of market fear, we expect treasury yields to come down. We should expect gold to rally, US dollar, yen, safe havens that do well. And to your point, we didn't see that really. And with dollar weakening just a little bit, treasuries had some response, but also, then you look started this week, yields kind of backed up just a little bit. And it's always dangerous to kind of read through the kind of tea leaves of kind of flows, but there's certainly, it appears that there's been a lot of deleveraging and you're selling what you can. And so, when you see kind of treasuries back up a little bit in a day when markets are feeling stressed, it's often a sign of repositioning. So it doesn't make us question, treasuries as a safe haven role. And if anything, it's kind of an indication of maybe we're at peak fear as people are looking to the things that they can trust the most to sell. And I think we're still committed to the idea that, treasuries make sense in portfolios, and, expect, should recession concerns become even higher or start to become real, we should see some movement on treasuries on that front. But it's been a long time, I would say, since we've seen combination of sentiment being this weak, which, some of your comments earlier, we're months into kind of bullish sentiment really coming down in a really severe way. And then VIX above 40 is always a bit of a triggering point, I think, for many of us, where it's almost an instant, let's rebalance, let's get back in the markets. And if anything, you would expect a lot more dislocation with these levels of kind of just lack of positive sentiment, high VIX levels, and the vol levels that it's been more orderly, you could say, than you might expect. Doesn't feel like that, but certainly could be a lot worse. Maybe just, pivoting a little bit to, some of the specifics on tariff policy. It seems, I think we all can speak to this, markets are grappling with, the Trump administration's tariff policy and whether, should these viewed through the lens as a negotiation tool, or should they be viewed as, tariffs are a structural policy change to really, adjust some of the economic foundations of the U.S. economy? And markets are struggling, positive, negative days, to discount those two outcomes. So you've spent a lot of time, Jen, thinking about tariff policy, and whether it was 4 years ago and now. Can you share some of your thoughts on just perspective on tariffs policy and maybe some of the details that folks may not be as familiar with?
Yeah, this is such a great question because as you know, every time we talk about tariffs, we kind of stress how important the details are on tariffs overall, which, it's not the most exciting thing to go through, but they're really important for determining what the ultimate economic impact is going to be. And, that's a little bit of the difficulty with some of the announcements we got as of late is that, theoretically, we did get more details on the direction of trade policy, but there's not a whole lot more clarity for the market in terms of, that push you're talking about between the negotiation tool versus is this a more structural change in policy? So, that uncertainty still exists, even though we do have a few more details at play. But one of the aspects that I think is quite important is just the method with which tariffs are implemented. So with the announcements we saw on April 2nd, they were enacted through the International Emergency Economic Powers Act, or IEEPA, as it's frequently called. But, basically this authorizes the president to address national emergencies through extraordinary measures. And historically, we've seen this used for sanctions and for other purposes, but never actually for tariffs. So there's a little bit of a question mark there, I think, in that use to see if there is a legal basis for that. And I think you're seeing some headlines around a little bit of challenges that are coming about because of that. But that is a very easy way for the president to put tariffs into effect almost instantly by using IEEPA. So there is an attractive quality, for him for that. But the other thing that I just call attention to with the recent announcements, we did see quite a few products exempted that I think have been mentioned as potential tariff targets moving forward. And the reason that I bring that up is that I wouldn't expect those to be covered under IEEPA, that we would actually see more specific sectoral or product-specific tariffs announced through more traditional means, but those have some limitations in scope and rates and investigation processes and things that take some time. So all that is to say, we have more details. I think the tariff rhetoric is likely going to stay because of that extended timeline we could see for some of the other announcements in the pipeline.
Which I think is a really important piece to emphasize of, we throw a lot of taglines out of, we've seen this turmoil with tariffs, but it's really about, there's going to be volatility. We want folks to be bracing for this volatility. And even if we see some easing on whether it's the retro or whether it's the recent tariffs that we've seen, the reciprocal tariffs or others, even if we see those ease back, there's further investigations coming. There could, as you mentioned, sector-specific tariffs. You get I know you've spent some time deep in the tariff codes that outline each product and the serial number attached to it and tariff rate attached to it, building those up by country level. It's actually a fair amount of bureaucracy behind it that is associated with how you implement and manage tariffs. And so it's unlikely that this will be something that concludes quickly and we never talk about again. I think this is something that we're going to be living with for a bit now, and just think about that as we think about kind of market volatility in that environment. And I think one of the things also for us to kind of think about is with a effective tariff rate essentially as of tomorrow, if everything's implemented, or tomorrow being April 9th, be over 20% an effective tariff rate. Should that stay in place, we're likely on a direct path to a recession in the United States, and typically being recession in the United States leads to a recession globally. How are you thinking about just the economic outlook and thinking about growth rates, inflation expectations or implications, and also the Fed's potential response or the Fed's lack of response that we may see of this?
Yeah, maybe I can start with the inflation side just because you hit a little bit on the growth piece already, but I think the way that markets are reacting to tariff announcements, you're seeing basically this pricing in of higher inflation hit to growth on the flip side. And on the inflation side, I think it's true that prices are going to increase on a one-time basis when those tariffs go into effect. Just by nature, that is how it flows through to our inflation calculations. But I think that the distinction I would draw is a one-time price increase versus a persistent source of inflation moving forward. So, something that would continue to increase at X% per year. And tariffs don't have that impact as long as the rates stay at the same level. So we would expect more of a one-time price increase. And what's difficult about the announcements we saw is that they are so broad in nature. So you're talking about very broad price increases versus some of those sector-specific ones. Like we saw in 2018, washing machines were the best example, where you did see prices acutely move higher for that particular good, but not as big of an impact on the broad CPI or consumer price index basket. So I think it's possible we could see that broader price pressure flow through in the near term, but it doesn't really change the long-term outlook for the rate of inflation moving forward. And I think the growth side is something that maybe I'd like to get your perspective on too. But one of the complicating factors here is just all of this uncertainty, I think, brings almost this stalling effect to consumers and businesses, which does flow its way through to economic activity and ultimately GDP. So that's maybe the biggest area of concern for me in particular, but interested to see what you have to say as well.
Yeah, and I think we'll see some of those concerns start to pop up by the end of this week. And so as we think about, how do expectations start to flow through kind of the economic machine? And so higher uncertainty tends to lower CapEx, or just means people pause decisions, pause activity. Think about this from an M&A context in the banking world. Whether it's buying private companies, whether it's moving through mergers. Many of the largest banks report end of this week on Friday, and we'll hear from them in terms of their guidance. And it's unlikely to have improved from their prior earnings calls. And I think that's the piece that starts to flow through, that once you have a little bit of kind of expectations and kind of poor sentiment take hold, it's hard to pull it back. So there's a little bit of the clock is ticking for when do we start to see some declines in corporate profits? When do we start to see consumers saving more? How does this then impact overall consumption levels? And it's fair to say the U.S. economy and probably the world economy is driven by the U.S. consumer. To what extent do these tariffs disrupt that mechanism and that engine of growth for the world? And that raises clearly a lot of questions for folks. And
I think you take some of those comments about the potential inflation uncertainty and growth uncertainty, and you bring them together, and it sounds like a very complicated position for the Fed to be in, given their mandate. So that is one thing. We got last week some Powell comments where it sounded more like a wait and see approach that they would be taking as well. And I think, that's the risk, that we don't maybe have a preemptive cut coming because of those dynamics.
Yeah, and for almost since 2008, if you will, any sort of market crisis or liquidity issue, market events, we've mentally been able to quickly pivot to say, okay, the Fed will help us. The Fed will provide some ease, and kind of help markets along. And the Fed's been very clear. They're going to have a wait and see approach, and there is not a real strong impetus on their part to be proactive with policy adjustments unless we start seeing real severe losses in the private workforces. And as we know, job losses are one of the most lagging indicators for kind of economic activity. So if you see a course of 2 million jobs lost in a 3 to 4 month period, recession's already started. You're just seeing it then, and that's I think some of the concerns that many of us share is the Fed behind a little bit already, and we should be in a bit more of an easing cycle, which we're seeing some central banks outside the U.S. start to think about that a little more proactively. I wanted to round up just thinking about kind of some high-level portfolio advice that we've been sharing, kind of maybe quick high-level line items. When we think about rebalancing activities, VIX at levels above 40 in our minds is a clear indicator, that fear is high. We should be moving back into markets, not leaning away. At this point, S&P 500 is both the easiest and we think probably one of the better options to be able to move into equities. And then also, as we look at treasuries are still a safe haven. Yields haven't moved as much as maybe we'd expect, and so to some degree, not a bad place also to be adding some liquidity, adding to treasuries in this market environment. And if you can do both, that's excellent. And any other thoughts, Jen, from your side on thinking about portfolio actions or things for folks to be considering in today's kind of challenging market?
Yeah, I think the two aspects you mentioned around S&P and treasuries are probably the top of mind. But I'd also just add that we've been highlighting that we really just don't want to be adjusting portfolios too tactically given the news flow. As we've seen, especially with the moves we saw on the 7th intraday, we can have some head fakes in markets sometimes if we get certain headlines out there. So I think we want to lean into the strategic asset allocation targets that have been put in place when things were calm and have been very thoughtfully constructed. So I think that becomes more important in this type of environment today.
Thank you. That's excellent guidance, and we will wrap up with that. I want to thank everybody for joining. Again, if you do have questions, please reach out to your consultant. Please look to our website, which we're posting a fair amount of content, and we'll continue to do so as updates come. And hopefully we all see a more muted and quiet week than we saw last week. And thank you all for joining.